In Unit 8, we're going to learn about retirement. So our first learning set for Unit 8 is retirement income from savings. And this is Unit 8 Learning Set 1. So our objectives are to calculate future values of retirement investments that are both single deposit and periodic. Compare the tax savings by making contributions to pre-tax retirement savings accounts and calculate an employer's matching contribution to a retirement account. Okay, so in our first example, Blythe is 40 years old. She is planning on retiring in 25 years. She has opened an IRA account with an APR of 3.8% compounded monthly. If she makes monthly deposits of $500 to the account, how much will she have in the account when she is ready to retire? So we learned in Unit 2 how to use our interest formulas. So now I'm going to show you how to do the same thing on a online calculator, and we're going to use this interest calculator. Okay, so on calculator.net, it takes you to this interest calculator. So, and then I'm just going to go back to the page because I screenshotted everything. So, on here, we need to find our information that we want to use. Okay, so we know that she's retiring in 25 years. So that gives us a length of time. She opened an IRA with an APR of 3.8%. It's compounded monthly. So, and now she's making monthly deposits of $500. So in this instance, we don't have a starting principal because we're making monthly deposits. We don't have an annual contribution. We have a monthly contribution. So for this one, we're going to enter in $500 monthly. Our interest rate is 3.8%, and on the online calculators, you don't have to convert it. It recognizes it as a percent. We are compounding monthly. That was on our green. So after 25 years, that's our time. Our tax rate, we're just going to put 0% for tax rate and inflation rate, and we're going to hit calculate. And when we hit calculate, it's going to tell us what our end balance is when she retires. So our end balance when she retires is $250,553.77. And this online calculator will also give us additional information. So her total principal that she invested, which you could really say is 25 years times 12 payments a year times $500, and that's how they got the total principal of $150,000. So then the difference between the end balance and the principal is how we got the total amount of interest she earned. So she basically just about doubled her money. Close. Not quite, but close. Okay, so building on this example, which would have a greater effect on the final balance of Blythe's account? Half the monthly deposit or half the interest rate? So we use the same information. The only difference is on this first one, we had half the monthly deposit. So our monthly contribution changed from $500 to $250, and it gave us the result of an end balance of $125,000, total principal $75,000, total interest. Okay, on the next example, we wanted to change half the interest rate. So on this one, what changed was this interest rate to 1.9%, and that is kind of messy. Okay, so that is 1.9%. So the monthly contribution, we had changed it back to $500. So as a result of that, her end balance was $192,000. So if we compare the two, they want to know which would have a greater effect on the final balance. Well, remember, the left is a monthly deposit, the right is half the interest rate. So half the deposit would have the greater effect by her not getting quite as much. Okay, so now let's compare if her contribution was pre-tax. That means did she get taxed before or after when she pulled it out? So how much did she save in taxes in 1 year if her taxable income for that year was $72,500? So now remember, Blythe deposited $500 monthly in example 1. So her annual contribution would be 500 times 12. So she deposited, or she invested $6,000 annually. So if we look at the first example, Blythe's taxable income, excluding annual retirement, okay, that's where we are looking at the $72,500. And if we go down our tax table, $72,500, single gives her taxes of $14,475. Now, if we included her retirement contribution in with her taxable income, that means her income would raise up to $78,500, which would change her tax amount to $15,975. So by her putting this contribution as pre-tax dollars, we can take the difference between these two tax dollar amounts. We subtract the $14,475 from $15,000. That's a $1,500 saved in taxes. And remember, in the long run, this is going to make a difference when she retires, because the amount she pulls out in retirement is not going to match the type of salary she's getting now. So that, by default, is going to lower her tax too.